Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of May 25th, 2025. And in this week's episode, I'm joined by fellow Blockhead trader Viperxl007, and it is still earnings season. Earnings season is really winding down, and as you know, if you've been listening to the past several episodes, Viper has been experimenting with a new earnings strategy that he's kind of come up with on his own from looking around on the internet and stuff. And so we're going to check on this little experimentation that he has going as he's starting to get an appreciable number of trades under his belt to start to gauge how this particular strategy is panning out for him. And so we'll touch on a few of the tickers that Viper has been trading with this new strategy. But before we hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading, love to hear what type of content you want to hear about. Also, you can find a link to thetagang.com/sprocket888, as well as /Viperxl007, where we post each and every one of our equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcast, so please look us up, subscribe, and if you can't find it there, let us know, and we will get it there. But let's hop to this week's content. Viper, the earnings season continues, and I absolutely love earnings season, as we've talked about before, and I think it's really just about the speed at which price action occurs around earnings. And this past week was again no stranger to it. It actually was an incredibly busy week for me for earnings. So my screener was pretty full of trades, and I actually ended up taking 10 earnings trades. And you know, so far so good as they're knocking down. But one of the things I just absolutely love about them is how puffed up in volatility the targets that I go after are. And then you hit that earnings announcement and the price is just racing, presumably to the next level. And it's just like price action turbocharged. And I think that's what I like a lot about it, because your trades unwind so fast. And it's kind of known of when it's coming. It's almost like the start of a race where, you know, you got all your runners lined up and like on your mark, get set, and then go boom when the earnings come out. And then it's just off to the races with the price action. And, you know, sometimes they don't go anywhere, and that's great for my strategy. But I think it really adds a lot of excitement to it. And the one thing that I've really noticed, this week in particular, there was a bond auction that went off on Wednesday, 20-year bonds, and it went off horrible. Basically, the prices and the liquidity were very, very poor. The bond traders that were buying the bonds basically didn't come anywhere near the price that they wanted to sell the bonds at, which then tanked the equities market. Because it really drove up the long bond and interest rates on the market. And whenever that happens, a lot of the equities really get kind of skittish and scared. And so we had major indices dropping 2.5%. And the earnings trades that I had on at the time, you know, the market was tanking, were just so beefed up with volatility and so just kind of uncertain. And the earnings announcements, they barely budged. Which I thought was crazy, because I thought, oh my gosh, here the market's tanking. I got all these earnings trades because I always enter my trades on Monday. I'm like, these things are going to be way off center. And sure enough, it's like all of the names are held in limbo here until it's like they're all those runners waiting at the starting line for the earnings announcement to come out. So it's just a lot of exciting for me. Viper, I know that earnings season is probably not something you've been tracking much until recently. So talk to me about how it's going, and are you finding interest in earnings season? Probably not quite to the excitement that I guess I have, but how's it treating you?
So not bad. I mean, I definitely understand the appeal much more than I did before. And I mean, I had a sense of it before. I just didn't have a vehicle. You know, obviously all of the vehicles you use, we've talked about before. I vaguely understood them, but obviously a lot of them consuming a lot of buying power, things like that. It just didn't. There wasn't the right connection of vehicle to use that I understood. Risk profile, all that good stuff, and reward to that risk to reward ratio and whatnot. But now that I've been through several weeks of it now, it definitely is much more exciting now. I see where the appeal comes from. I'm still, like you mentioned, dialing in that vehicle that I am using, and there's still some unknown questions of the best way to deploy the vehicle, which is still keeping me in the early minnow stages of, these trades are certainly not bringing in any moonshots. And as goes most option strategies we talk about here, none of these are meant to be moonshot plays. The calendar spread, as we'll get to in a minute here, is by its nature meant to be 100% defined. Due to something we'll talk about in a minute, I guess we'll say 90%, 99% defined. But so loss, and by defined, I mean your max loss, and I'm going to air quote that. Max loss is known when you open the position, and max profit is known. But again, I'm discovering there's some grayness to that. There's not as much of a definitiveness as a brokerage that's trying to sell you a predictive cost structure might want you to believe. But that said, it's definitely getting more exciting. But definitely finding the need to continue to just take it slow and get this thing dialed in, get the statistics gathered before I start cranking these positions into much larger positions.
Excellent. Well, hopefully your interest in earnings season continues to grow, as it can be very exciting. So as I know, what brought you into this earnings season was kind of an advent of a new strategy that you've been kind of dialing in. Talk to me about how that's going.
So let's first jump into some performance data here. I have my trade tracker, my trade journal here. And some of this might be hard to read, which is fine. The specific numbers, I mean, they're important, but they're not important, for this discussion per se. But obviously everything's color coded. Green is a win, red is a loss, yellow is a still active trade, still active position. So I mean, it looks pretty good, right? And we kind of talked about this before. A lot more green than red. And again, just to recap the previous episode where things went really south, was this Lulu loss here where position sizing was completely out the window. I did not do my job there. So if we slide over here and see the total debit and the debit, the way that I'm doing calendar spreads is a debit calendar spread. So I am selling a call, or I'm selling an option up front for the short month, and then I'm buying on the long month. So the position takes a net debit to open it. So you can see that Lulu one was a $500 debit. Clearly blue. And what I talked about before is I'm trying to keep these trades to $100 entries. And that one just right out of the gates blew it out of the water. It was a big loss. And so it really skewed the data, to say the least, but we leave it in there because it is data. It is part of the strategy and the data collection. So performance-wise, if we slide over here to the stats, you can see I am still net loss, and that is thank you, Lulu. But I do have a win rate of 66.67%. The average win is 54%. The average loss is an 80% loss. And my Sharpe ratio there is 1.94, which I believe is not bad, fairly average. So because these positions are meant to all be around $100, we can just kind of project that percent to say The average win is around $54. The average loss is around $80. But with a winning rate of 66%, that, should work out to my favor over the long haul. But you can see the chart here. These are the trades so far. We had the big loss, Lululemon, that sent us way down. We had these winners here, but we had a couple 2 or 3 losers that drag us back down. So still need to figure out some of that exit. I feel like one of 2 things needs to happen. Exit strategy needs to become more clear, so that way we rein in this 80% average loss, or we dial in and bring the win rate up. I feel like I'm at a point where one of those 2 things needs to happen. But overall, that's where the performance is at on 26, 25, 25 trades with a handful of open ones.
Yeah, Viper, actually, it's very curious that you actually calculated your Sharpe ratio, as that is one of the kind of efficiencies or risk to reward ratio that you have. And just to comment on that, only because I recently kind of was looking into the Sharpe ratio and kind of calculating it for my strategy over the hundreds of thousands of trades that I've actually put on. My Sharpe ratio is actually only 0.48. And so you want a higher Sharpe ratio. The higher the Sharpe ratio, the better you are. And just to frame it up a little bit, anything between about a 1 and a 1.5, which is where you're falling, is considered kind of professional level risk reward. Just to give you another frame of reference, Warren Buffett's Berkshire Hathaway Sharpe ratio is about 0.8.
All right. So it might be a little inflated right now. This is what I'm hearing.
Either that. Well, I mean, actually, the way that you lay out your strategy, I think it is inherently tilted to a pretty decent risk to reward ratio.
Yeah, that's true, and I do take that into account. I mean, even though, like I said, I don't fully understand the flaws in it, so that's why I don't want to dig too deep into what I'm about to say. But when I open these positions, so I use Robinhood, and Robinhood will give you the max loss and it'll give you the max win. And so I have discovered, like I said, there are flaws in that calculation where it is not perfectly accurate, mostly because, and it wouldn't surprise me if a lot of other brokers do this as well. But I believe those calculations are based on a linear performance of the options. It's not accounting for volatility crush or anything like that. So it's basically saying if you open this and we have a linear decay on all of the different Greeks and whatnot, here's your max loss, here's your max profit. But regardless of the specifics of that, I do look, if something hits my screener and that max loss and max profit are kind of 1 and 1, then forget it. I'm out. I don't even take it. So I do look for a risk to reward ratio where that's represented in that max loss, max profit on top of the other screening criteria. So I do think, to your point, that there is some risk to reward ratio built into the strategy. There is a key note in the spreadsheet that that says these stats are meaningless until you have at least 100 trades, 100 plus trades, and that's just a nature of statistics. So, I'm happy with how the tracking is going. I'm happy with the stats I've collected so far. It's giving me actionable items to improve on and iterate. But I'm certainly not letting myself get carried away, until I get at least to that 100 trade level, where it starts to be okay. Now things are dialed in. Now there's true performance here across multiple scenarios. So trending in the right direction, but need more data, Johnny 5 style.
Yeah.
So all of that said, there were some pretty decent lessons learned so far that I think are worth that I'm at least comfortable with my knowledge of, my understanding of either what potentially went wrong or what needs to continue to be tweaked. So real quick, let's jump to a little, just very brief explainer here of, because this is going to be very focused on calendar spreads. So I'm going to assume that, you have a basic understanding of options. If you don't, hey, pause this. Pretty sure we got a video that says, what are options? Something to that effect. So go check that out. I'm going to assume a basic understanding of options. And so I just want to go over real quick the calendar spread. So a traditional spread, I don't want to say traditional spread, but it's traditional in the sense of what Sprocket usually talks about. One of those spreads, a vertical spread, you would have, obviously naked, we're not accounting for naked. We're talking about spreads. In a spread, you would have a contract, at a certain price, and you would have a protection leg, at a different price. And so you're in this vertical position because you're all on the same timeline here, the same expiration. And what you're varying is your strike price. So a $10 contract and a $20 contract on the same expiration, usually opposite, but I mean, there's different, in the case of stuff that, that Sprocket talks about, vertical spread or an iron condor, you're going to have a sell and a buy, and that's how you give yourself that protection to, have contained risk. So that would be what I guess I'll call the traditional spread, just traditional as of this show. But a calendar spread is where we take, let's say, that $10 strike, and we say, hey, now I'm also interested in a contract at the $10 strike out here at April. So now we're horizontal and we're going this direction with it. So it's meant to have protection built into it. In the case of a debit spread, which is all we're talking about, I haven't even messed with, or for earnings, credit spreads just don't make sense. So option number one here is a sell. So you sell this contract, because we're for earnings plays, this expiration is as close to earnings as possible, as close to after earnings as possible, because this is the one that's all juiced up for earnings. That's the whole point of this, is this one's got the premium packed into it. And then our protection leg out here is the buy, and we buy this contract out here. And, we put ourselves, this is actually a little too far, but nonetheless, we put ourselves further out in time. And that's because that volatility impact for the earnings event kind of decays in its effect as you get further out in time. And so the whole purpose is, this is the protection, because as you can see, this is a $10 strike. And so no matter what the price does around that $10, we have these two contracts that are kind of holding each other in yin and yang and lockstep with each other. And so that longer one doesn't lose its value as quickly. And so the idea is that once the first one gets its volatility crushed, loses a bunch of its value, you could potentially sell back. You could buy back the first one lower, just like you would do with a naked put or a naked call, after the earnings event. And then the second one still has most of its value, let's say 80% of its value. And so you could potentially sell that one back and now your net profit, ideally. So that's the very high level gist of the calendar spread, the debit calendar spread.
No, I think that sums it up pretty good there, Viper. Where the calendar, it sounds cooler to say calendar spread versus a horizontal spread. Calendar meaning you're moving in time.
So let's jump over to where some of these learnings are now. So now that we have it in our head, we have that horizontal chart, and And so it seems like there's kind of two. I'm consolidating to two trains of thought. Even though I'm going to enter a third one now as I think through what I'm about to say. But the first train of thought is what Sprocket brought up previously when we talked about this, where this idea that the point of a calendar spread, and I guess I don't want to pigeonhole it too much. So instead of saying the point, I would say one particular deployment of the calendar spread would be that the whole purpose of the short month is to finance or get you a discount on the long month call or put that you're buying, because you have more premium packed into that first one. So you sell that, you collect a whole bunch more premium, and then you use that to reduce the cost of buying the long month on the long month option. And that certainly, as I've discovered, is very much a very valid use case of the calendar spread. And I mean, I see it all the time. You know, I didn't have the numbers on the screen here, but just looking at one of the trades real quick that I put on, you know, one of the call that I bought normally would have cost $9.34 for this one trade. But because I sold the front month for $7, that means that $7 goes towards the cost of the long month. And so I end up, you know, paying a debit of $2. And so if the short month, the first one, if that expires worthless, now I have a super discounted call or long option on the long month. And so that is very much a particular strategy. So the other strategy that is the one that was in my head when I started this is, this is Zillow. I played this, but we're not worried about what I played. This green dotted line might be hard to see, but this line here is where earnings were. It's now the big green line. And when I first heard about this strategy, and so therefore my own natural bias and tendency to it was, let's not care about price, but let's just say there was, my options going into that earnings event were these two strikes, just above and just basically at the money strikes. And so the strategy for earnings that I first came to know was pick one of these, pick either the call or the put at the money strike. So grab that spread as close to the money as possible. And your whole goal in this strategy, in this particular variation of the strategy, is that the earnings event happens and then price eventually normalizes near your strike, whichever strike you picked. And then you exit. You don't wait for any expirations. You exit because now you have fully captured whatever the volatility crush was, because you're buying back whatever you sold and you're buying it back less the volatility premium. And then you're also selling the long month and you're selling that back near, 80% of its original value. And so on this chart, we can see that, had you done that, had you taken, the strike at the money here, price certainly, the earnings gap, jumped way down, but it came back up. It was pretty volatile. We overshot to the upside, but then it, came back down where you had a whole trading day here. Technically 2 trading days, but where the price is right back where it was before earnings. So that's certainly the other school of thought where I constantly kind of go back and forth between as to how to use this vehicle. Where I've settled is cool, either or. Where I've mostly settled is I have started trying to take the at the money strike. And in just a minute, I'll go through an example of exactly why I'm starting to do that. But I have settled to at least take at the money strike. And then if the post earnings price action does come back and normalize like it does here in this chart, fantastic. Then let's just close the thing out, never take anything to expiration. We're not worrying about paying for the long option, so that way we have this whole new position. We're just capturing the volatility crush and let's get out of here, the rapid pace of an earnings trade. But if the price runs in a particular direction, that is beneficial to me waiting it out and taking the expiration and, turning it into that play where now I have a discounted long option, I'm certainly open to that. And that's kind of where I've landed as far as how best to handle these post earnings is you got options.
So if I understand what you're saying correctly, you're basically saying that post earnings, if you are moving against you, you're in the money or kind of at the money or something like that, basically you're not expiring worthless. You're saying close it out for whatever you can at that point. But if it looks like you're going to finish out of the money from your front month, means it's moving in your favorite direction to you, it's go ahead and hang on and let that front month expire and stay long.
Yeah, exactly.
Month.
So, and this has come up, and I'll show a couple of these, but exactly what you just said, where if the first move post earnings is technically against me, and what I mean by against me is the calendar spread itself just loses money because the price went way out of the money. Then that's a situation where, okay, it's not going to give me an immediate win because the spread is now worth less than the debit that I paid to open it. But like you just said, if it's out of the money, then that means, hey, I now have this time gap that I can play with. So let's let it ride because now it's out of the money. The short month, the contract that's expiring within a week is usually where I'm always at. That thing's just going to be worthless. So let's let that drain and we'll have 100% capture on that premium. And now I have 1 month to 2 months because I picked the long month somewhere in there. I have 1 month to 2 months for that price to work its way back towards the long option that I have. And then it's a much more delayed trade, but still the potential for profit there. Versus if it moves deep in the money, the volatility is still gone. The price of the short month and the price of the long month now have a much closer connection. The short month is it's so close to expiration. The short month obviously is priced almost exactly to the intrinsic value. The long month still has its time value, its extrinsic value in it. So that one's always going to be a little bit higher. So I can still get some money back out of the play because of that. But if it goes deep in the money, I typically don't want to mess around with it. And let's just take whatever I can get back and move on. So one example here of a pretty much worst case scenario is QUBT, quantum computing. And so worst case scenario, because expiration day was way here. So earnings is this first dotted line. $10 strike was where I took the spread. And so earnings happened and boom, we magneted right to $10. And so after hours, I think I even messaged Sprocket. I was like, perfect. We nailed the $10 mark. This thing, if we open up at $10 here, that's perfect. I'll give it an hour or two on market open and just kind of let things settle out. And then let's just close this thing out and move on. Obviously, that's not what happened. We way overshot the mark here. And we were up at almost $13. So almost $3 in the money here by expiration. So this was an incredibly short expiration. This was a next day. This is a 1 day to expiration. So there is something to be said here that maybe that's too close. Maybe I should make a rule of 4 days to 8 days, or 4 days to 10 days to expiration. That's something I need to play with. Is 1 to 3 days just too close because of exactly this scenario? So what I mean by that is we're $3 in the money here, and we get up here. So I'm about to be assigned short 100 shares of this position because that front month is expiring. The long month is still active. So the long month still acts as my protection. If this was a much larger position, $100 underlying, the long month still protects me from being on the hook for some ridiculous bill. But so the way this ended up playing out was we hit expiration. And one shortcoming of how Robinhood handles this is Robinhood does not let you short stocks, which is probably its biggest issue. The biggest issue I have with Robinhood is they do not allow you to short stocks. So that means come expiration, what are they going to do? They can't assign you these shares short because they won't let you hold a short position. So they essentially go through their books and they do give you plenty of warnings that this is what they're going to do. But about a half an hour before before the bell, so around 3:30, they start sweeping through the books. And anybody with a position like this that's deep in the money, about to be assigned short, they just buy it back at the current price. And so this was essentially a $3 buyback of the short month. And then I was left with the long month. And so then post being forced liquidated on the front month, I now have a $10 long option, which is in the money at this point. It's in the money, $3. So, I could exercise that at this time and get that $3 back. But you can see now price has since then come back down to $10. And so this is worst case scenario because I bought that short month at $3 in the money, only to have my own long option decay in intrinsic value almost back to $10. So I've kind of lost that value as time has gone on here. So this was a good lesson in what can go wrong when things go sideways in a bad way. The way that I'm handling it is I'm using that time. Time is on my side. I think this one was a 2 months to expiration on the long option, so I got plenty of time. I have literally 2 months for a price to. I mean, it's not necessarily going to move in my favor, but I have 2 months to watch this. It's holding, that time extrinsic value. It is going to start losing that, but if it's something that I want to hold, then it's, I have time on my side that, maybe we can get another run up to 13, 14, something even higher over the next 2 months, where now I'm much more in profit than had I just closed this thing out at a loss up here. So the next one was interesting. NU, new holdings. And so what I did on this one was I called it my calendar condor. I mean, it's officially would just be called a double calendar. I took a calendar. These are two separate positions. I took a calendar spread on the $14, took a calendar spread on the $12. And we hit earnings, which is right at the start here. And for a while, your Flappy Bird chart, we just shot the gap right down the middle, except in my case, this was worst case scenario for profitability, because for one of these legs to be profitable, we have to be near, if not on, the yellow line, on the strike. So right down the middle was worst case scenario. There are multiple days here where we were just taunting me. $13. 13 is the dead middle between 12 and 14. And for 2 days straight, it just sat there right on 13. Like, you thought you were cute trying to pigeonhole success here by taking 2 double spreads. But then it finally gave up. So what happened here was the good side of the near-term expiration. So in this particular case, Friday, May 16th was expiration. So right in the middle here, we hit expiration. The good thing about being down the middle was both short months expired worthless because I had the $14 call and I had the $12 put, and at expiration both of those short months were worthless. And so that was cool. So now, as of right now, I have a long call for the $14 strike and I have a long put for the $12 strike. And as you can see on the price action here, we actually just today came screaming down to $12, and now that long put is very nicely in profit. And so at this point, we'll see how the rest of the week plays out. But at this point, my thinking is I need to do the math and see what I'm on the hook for, what I paid for the long call. Because ideally, let's say we drop to $11, ideally, if I could cover the cost of this long call and still have some profit, then fantastic. The double calendar spread worked. And I used the success in one direction to pay for the loss in the other direction and still get some profit out of it. So this is still developing, but the other option would be that I just take the win here at $12, do some TA, some price action analysis here on the chart. And I still have, in this case, I know it's a July expiration, so I still have 2 months to go give $14 a test, or even get up to $13.50 or something, get close enough to bring some value back to that long call. So in that case, I just would want to take the win on the short call. I mean, the short put, or the long put, and then roll the dice on, getting to profit on the long call. But this was interesting. I don't know if I'll do it again, but the way this is playing out has been very interesting. Obviously, I did not take at the money strikes. So both of these strikes were intentionally chosen to be just outside the earnings range, the projected move, which shout out to statistics and the market for pricing that in. I mean, this swung in both directions. After hours, it swung just down here, and then opening, it swung just up here. And the strikes that I chose, like I said, I chose to be just outside the expected move. And I mean, that one, it's cool to see that was respected. It was that the market did an accurate job pricing that in. So the other thing that I learned about this particular play here, part of the reason I took the double calendar was because after taking the $14 strike, that's when it started to click to me of there's really not much purpose. This $14 was decently far away from the at the money strike when I opened it here. So when you're taking a calendar spread, especially around earnings, there's not a lot of value to take the calendar spread in one direction far out of the money at the time that you open it, because remember, we want the short month, the near term month, to have elevated premium because we're collecting that premium. And then we're using that in various ways or whatever. So when you take a calendar spread that's far out of the money, you're collecting a very small amount of premium because that you're taking a strike that's out of the action range. I mean, like I just said, I chose these out of the expected move. Once you get out of the expected move, that premium just falls off a cliff because the market is not expecting that. So that was, and so my point is, it's almost better to just buy the long call and the long put, and that's what you got. And because you're not capturing enough premium on the short month that you're selling to really justify the risk that's added by holding that short month, that short month option, should it go in the money. It just limits. It's not really a risk. It just limits your profitability efficiency, if you will. So the last one here is Target, which I believe you had a trade on. So I'm curious to see how my experience compares to yours. Target had earnings as of this recording this morning. I took the market. I forgot to mark it here. I took the $98 put. And you can see, so I think I opened it in the morning when price was at almost $99. I took the $98 put. So we are well into the money here on my calendar spread. So PTSD of QUBT. But I have a little bit of time. I have a few more days till expiration, I think. But I am profitable right now. I can close this thing out for a profit, which is most likely to happen tomorrow morning because, we've really settled out here. We had this push back up, and we've kind of settled back down. So assuming tomorrow's open looks similar, I'll probably just cash this thing out in profit. And so the thing that I referenced to before about what's kind of neat about being in profit for this is as it stands right now, I have two competing options that are both deep in the money. I'm on the hook for one. The option that I sold, I'm on the hook, but that's somebody's, has the ability to call that away from me, or put those shares to me. But I also have the ability to pass that buck to somebody else. So what's neat is despite the fact that I have these competing options, I'm still in profit because of the extrinsic value that's still latched on to the option that I bought. So the one that I sold, even though we went deep in the money, it has lost so much of the volatility, extrinsic, conditions that elevated its premium, that the long one, the one that's in my favor, is still heavier than that one. So therefore, I can still get out of this thing in profit compared to the debit that I paid to open it. So I thought that was neat because we are decently in the money here. I mean, we are 6% in the money. So that was neat, but I'm also not interested in taking this near expiration thanks to the experience of quantum computing and having that put automatically bought back. So,
well, in this case, you might be able to. Is it a call or
it's a put?
It is a put. Oh, so maybe Robinhood will let you go long those shares.
I guess that's true. Well, I don't think I have the margin for it, so they would probably just close the whole thing anyways.
Oh, well, that's a different problem.
But I believe this was one ticker that spiked up on your screener. So what compare and contrast option strategies?
Yeah, so if you can mark the 95 level on your chart, that's the strike that I sold. So I sold the 95 put, and we went and breached way below it. So ironically, and this kind of speaks to why you're in profit as well, when we hit that low point before we rallied back up to 95, my trade was green with profit. And that just speaks to the amount of premium that was baked into that option from before there. I mean, it was just so packed with premium, which is why I took the trade. And so this one, it's not the ideal. So ideally we would have stayed above 95 and I'd have collected 100% of my profit. But we breached it. And this one is not as bad because we didn't breach it very far. Like I said, I was still green at that low point. But what this is going to allow me to do is this is going to allow me to roll. And so by Friday, if we're not above 95, or even if we're right at 95, to be honest, because I took this as a one-sided trade. I did not put a strangle on Target because I really believe from price action that Target is approaching a bottom, like a legitimate bottom from a very long time, long period. And so what happens then is if you are close to an at the money strike there at expiration, that is where you have the most premium baked into it, right? Because at the money is always the most premium rich. And so all of the premium will have been bled off from the short month or from the one that I sold because it's expiring. So there's nothing left in it. And then I'll go ahead and close it out. Now, if it's in the money, I'll close it out for whatever intrinsic, but I'm going to turn around and sell the exact same strike further out in time. So that intrinsic value is all a wash and there's no extrinsic value. And so I'll really get to ramp up the premium that I collected. Now it is directionally biased to go up. But this is where I'm okay getting target shares assigned to me for 95, which is why I was actually pretty aggressive on the delta. If I recall, a 95 strike on target before earnings was a 35 delta, which means there was a 65% chance that it was going to stay above 95. So there was a 35% chance I was going to get assigned or was going to breach this strike. So I'm pretty happy with target just because it's going to, set me up for a really decent roll with how it's shaping up, or it'll rally above 95 and I can close it out for a full win. But like I said, I kind of am pretty bullish on target just on its price action. So, I might take the roll even if it's marginally out of the money, just to collect more of that at the money premium.
Nice. So at a high level, I would summarize our two strategies for people as the main reason anybody would do what I'm doing versus the main reason anybody would do what you're doing. The main reason anybody would do what I'm doing is like we've talked about before. My goal is to never hold any of these shares. My strategy is primarily exclusively focused on I am playing in the premium explicitly. Whether it's I'm initially taking a debit, which is based on the pricing of the premium, and then I'm looking to capitalize on premium one way or another to get profit out of that, and then I'm out of here. And then in your particular case, going naked on the put, you're still playing in the premium, but you're more rawly exposed to the premium in that you captured it, and whatever you captured, it's yours. There is no other, like, you didn't buy this other option to counteract or anything like that. And as we always say, you're okay with assignment, and therefore, the buying power and the account sizing, the position sizing, and all that good stuff is okay with that. And so I feel like those are two primary reasons why anybody would choose one option, one strategy or the other. And looping back to my strategy, so the key takeaways of everything discussed are: takeaway number one that I've got so far is absolutely I need to stick to at the money, one way or another, unless I'm going to do the double calendar thing. But again, I don't know that the calendar is the right vehicle for that double scenario because, like I said, the short month, you're just not getting a lot of premium out of it. So why wouldn't I just buy both the long option, the long call and the long put? Because that just seems like more capital efficient. Just buying those and then let's see how it plays out after that. So rule number one that I'm learning is stick to at the money on the calendar spread. And then rule number two is kind of what you talked about in Target there. And this is a rule from the beginning, but Target, because it was so juiced up on my screener as well, it really showcased not all of these spreads. I think if I wanted to caution anybody seeing this and wanting to get into it, not all option spreads are created equal. And that goes in your screening. You're looking at implied volatility, the IV rating, and in my screener, I'm calculating the IV-RV ratio, implied volatility, and realized volatility. And the whole point of either one of those things is look for the thing that is extra juiced And in my screener, I'm also, like I've talked about before, I'm calculating the term structure slope, where the front month is extra juiced compared to the pricing of the long month. And these are important nuances to what helps set up a more successful trade in your favor, because exactly like you just said, you breached almost to $91, almost $4 in the money, but you were still profitable because that much premium was packed into that thing. And like you concluded, I am still in profit because of that same exact situation where the 98 put that I sold had so much extra premium into it that even though we went this deep in the money, I'm still in profit because a lot of that bled out. So, and a lot of that is factored in by making sure we pay attention to either the term structure slope or the IV or the IV-RV ratio, something like that, that gives you that statistical edge.
Yeah, the last difference that I'll kind of call out that you didn't really mention, but I think it's a very key distinction between your strategy and mine is yours is a defined risk strategy, which you mentioned and alluded to. And defined risk strategies are very well suited for smaller portfolios. Undefined risk strategies, which are typically what I deploy now, they're really only suited for larger portfolio sizes. I would not recommend undefined risk really with a portfolio of less than 15,000 would be the smallest I would even say start dabbling in, and you're going to be limited at that point. But with a smaller portfolio, defined risk really is the way to go because it lets you really control that position sizing. You just can't get an undefined risk small enough for those smaller portfolios.
Yeah, that's a good point. And the last thing I'll say on that point, because I alluded to it at the beginning where I said I'm trying to keep all of these trades to $100 and stuff. So $100, let's say my average maximum profit is around $150 to $250 per trade. It goes back to what I said at the beginning of why I didn't get into earnings was because the risk and reward ratio just didn't seem like it was there. But I can scale this once I get the data, once I get the strategy refined. I can take multiple spreads. I could get that $100 spread and take 5 of them or take 6 or 7 of them, and do all of the position sizing math that we talk about and things like that. So I could still it is 100% defined, like you said, but it can still scale within the confines of that small account to be more quote unquote meaningful or impactful, because I mean, if you're pushing $10,000 to $15,000 in your account, it can feel like, what am I doing chipping away for $30 and $40 here, there. But if you have the edge, the statistical data proving that you have a winning strategy, you can always scale that defined risk to multiple copies of it, in just like you can in any trade, really. But I think that's
So I'll give you a homework assignment, Viper, is I would like to, because I'm real curious about this. I don't quite understand. Yeah, it does scale. But next time you line up some trades, go into a paper trading account and just say, I'm going to use 6K in buying power and put the same trade on a paper trading account. See how it pans out. I started with 1 iron condor, 1 vertical, right? And then I grew a little bit, and then I'm selling 4 verticals, 4 condors. And then I grew more and I grew more, right? And eventually I go to an undefined risk trade. I never really tried to keep that defined risk scaling up once I hit that threshold of switching over to undefined. So I really don't know the answer. But I just know that I don't put an order in for, oh, give me 100 contracts of this spread is what I think you're going to have.
I see. Yeah. The only concern I have with using the word scale is, I mean, it's still scaling, but the risk is that you have to be cognizant to the fact that you're even though it's a defined risk, you're still kind of playing with fire. And what I mean by that is the thing can go from whatever debit you paid, it can go to not 0, but it can go to a loss pretty quickly. I mean, you are playing with an earnings event. Those are volatile moments. You need it to be volatile to have that premium packed into it. And so I guess what I'm getting at is this goes more to risk mitigation, position sizing, and all that stuff that, if you're still paying a debit in the same sort of way why you don't like naked buying long options, because you're paying that money up front rather than initially first receiving the money in those more undefined scenarios. So that's the main concern I have with quote unquote scaling and making the thing with more copies, is that debit can still get zapped super quick.
And that brings us to the end of this week's episode as we continue down the journey of exploring the different learnings of Viper and the strategies that he's kind of picking away at when it comes to earnings. He's going to have to wrap up his earnings strategy here pretty soon, because we're going to start drawing blanks here as earnings season is really winding down, and then we'll have to pick it up again in about 2 more months. That's the nice thing about earnings. They're supposed to come around every, quarter. But they last for like for like a month, a little more than a month. So you end up getting earnings season almost every 2 months. As one dies down, you kind of get a 2-month pause, and then they start up and they go for four to 5 weeks of earnings, which is super nice. But we're kind of coming to the end of that period. So we'll see what Viper gets to lock in here as we finish up this earnings season and see what kind of tweaks he makes, or if he completely abandons it and moves to something else by the time next earnings season runs around. So stay tuned and we'll keep you posted. Hopefully you're having good luck out there trading whatever strategy you like to trade. Good luck, have fun, and remember, think outside the block.